Rich buy assets, the poor buy liabilities. An asset is putting money in your pocket, a liability is taking money out of your pocket.
Lessons that I learned from reading Rich Dad Poor Dad by Robert Kiyosaki. Number 1, reduce your expenses and liabilities. This is what people mean when they say live below your means. The top 3 expenses that everyone has regardless of where they live in the world is transportation, food, and shelter. You can optimize your expenses by driving a used car instead of buying a brand new one, renting a smaller place for yourself, and cooking instead of eating out. Number 2, aim for more valuable assets. Your house should not be your biggest asset. Invest in index funds and stocks, REITs and real estate properties, parking lots and vending machines, and royalties and dividends. Number 3, you become what you study. Read. Here are 4 books that helped me on my financial literacy journey. Rich Dad Poor Dad by Robert T. Kiyosaki, Money Master the Game by Tony Robbins, Little Book of Common Sense Investing by John Bogel, and I Will Teach You to Be Rich by Ramit Sethi. Finally, pay yourself first. The 50-30-20 rule works just fine.
One thing that everyone needs to know about an asset. Assets put money into our pockets. When you know how to buy them right, they pay your debt for you as well. So yes, when you borrow money, you pay interest. But when you use other people's money, your return can be so much higher, even considering the interest payment. So I don't know where you're learning from, maybe Ramsey, but on this side of TikTok, we don't cap.
I know we've been tricked into thinking we want ownership, but honestly, you don't want ownership. You don't want to own anything. It's a lot of liability that come with ownership, including tax liabilities. Really, we want controllership. We want to own nothing and control everything. If you got businesses, what you want to do is get you a trust, sign the rights to those businesses over to your trust, and now the income from those businesses that you would usually have to pay taxes on, now that income is by law not considered income. It's considered an extraordinary dividend, and you can defer the taxes until you die.
Once upon a time, I sold a big ass house and I made $137,000 in commission on that one house. And rather than taking that money and investing it in real estate, I went and bought a brand new Mercedes. I went on a shopping spree and I pissed that money away. Instead of buying a townhouse on Lenox Road, it was right in the middle of foreclosure season. I could have bought that townhouse for $100,000. That townhouse today, that in 1995 was $100,000, is $1 million. That Mercedes is worth 0, and those clothes don't fit. This is a cautionary tale.
What is an asset and what is a liability? Well, an asset puts money in your pocket. A liability takes money out your pocket. Right now we're walking a parking lot full of liabilities. Not only does it take money out of your pocket, but the moment you drive one of these off the lot, it decreases by nearly half the value. Let's take a look at what an asset is. Now this is an asset. It's a multi-family property that has 8 units. Each one brings about $1,500 a pop. That's $12,000 a month, minus your expenses. You created something called positive cash flow. Remember, when you're getting ready to make that next investment, assets put money in, liabilities take money out. You choose wisely.